Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, February 18th, 4:52 p.m. Eastern Time, coming to you from San Augustine Beach, Florida with The Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look at what you need to know for next week, and update the world-famous 21 over 21 leaders list. Also going to take a look at 25 or so gaps from recent earnings. And you can see in most cases in a bull market, bullish gaps on earnings are usually lead to accumulation. They're certainly not doing that, and that's a big sign for the state of the market that we're in right now. And state of the market, speaking of which, we are in a bearish consolidation. We had a second weekly close under the 200-day moving average. You know, from studies that we've done, webinars that we've done, once the market closes below the 200-day moving average, that's where risk significantly picks up. 12 bear markets since 1970. All of them started with a weekly close below the 200-day moving average. Not all of those, of course, lead to bear markets, but that's where the risk picks up. Leaders have been, growth leaders have really been taken apart. We still have some decent leadership on the 21 over 21 list. In fact, it's holding up pretty well. Let's go over here to the trend gauge. You can see we still got neutral on leadership. And, you know, when I end a week with a collection of 21 stocks, and by next week I'm taking off 9, 10, or 11 of them, then we know we've got an issue with leadership and we go toward bearish in that situation. But over the last 3 weeks, I think we've had 2 changes, 5 changes, and then 2 changes. We lost 2 this week. So for the most part, they're holding up okay. Not making a lot of progress, obviously, but that's how bases are built while markets are correcting. And when these stocks go sideways and create good basing patterns, and then the market rights itself, that's a launching pad to higher prices. So that's why we want to keep our leaders list fresh and keep track of how they're behaving. So neutral on leaders, but as far as the 5 major indexes and the 3 time frames that we track, we're in bearish downtrend on all 3 of them. That's the 21-day exponential moving average, the 50-day intermediate term moving average, and the long-term 200-day moving average. In fact, today we were just downgraded today with our second weekly close on the S&P below the 200-day moving average, joining the rest of the indexes underneath there. So stay away is what this means. The red arrows, that's what it means. So what happened? I mentioned second weekly close below the 200-day moving average. We'll look at charts here momentarily. G6 continues to lag, down 1.6%. Some of the G6 reclaimed their 21-day moving average earlier this week, but that was quickly given up with Wednesday, Thursday, and Friday's action. So that's one of the things we're monitoring closely, is for some strength to come into there and then persist, and we're certainly not getting that. S&P 500 down 0.7%, very volatile afternoon on the S&P. Nasdaq 100 down 1.1, Dow down 0.7, mid caps down 0.5%, Russell down 0.9. Diversified 60/40 portfolio down 0.38%. In-house, we were down 0.07%. down to one holding, that's an broad energy ETF. Everything else punted, so we're literally 99% in cash. Let's go to the tail of the tape, and then we'll go to the charts. So first, let's go to the team here at Revere, instituting our plan this year to avoid harsh downtrends. Participate in uptrends, get out of the way in downtrends. It's a common theme in life that people do that, take corrective action when things aren't going well. That's what we do with portfolios. We're technicians here. We use fundamentals and technicals to buy stocks. We use technicals only to sell stocks, because the fundamentals always look good at the top. And if you're interested in more information on this approach, you can reach out to any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's get to the charts here. We'll start off with the S&P 500, and I will also bring up the tail of the tape. So let's start with the tail of the tape first of all. Bearish consolidation, headwinds, been here for a while. Strong U.S. dollar, inflation, Fed tapering, raising interest rates, and Russia-Ukraine tensions. Sentiment, put-call ratio seems high at 1.17. We need to get this up to around 1.4, 1.5 to really that would probably correspond with a big shakeout in stocks, similar to what we saw a few weeks ago on a Monday, where it really spiked intraday, and that put in the temporary bottom, which we're in the process of testing again. VIX elevated at 27.75, which is actually down from yesterday. Fear and greed at 38, that's showing fear. So our bull case, S&P reclaiming the 200-day and initiate a rally. Got a little bit of that this week for 2 days, but the last 2 days totally undid it. So we're back to our bear case here, the S&P back below the 200-day moving average, and that's typical of bear markets playing volleyball, in this case with the 200-day moving average being the net. We got back above it for 2 days this week after 2 closes below it last week. Now Thursday and Friday, 2 closes below it and a lower low. On the news front, continued conflicting reports from Ukraine headlines. So what I was watching today, what would the S&P 500? It's under the 200-day, going back and forth. What did we have today? Well, a lower low, and that's certainly bearish. Action, we started off basically flat on the day, had a brief pop, then 3 legs down, creating an undercut of Monday's low. Strong afternoon rally, but that rally was sold into the close. Another distribution day. We've got 5 on the Nasdaq, 4 on the S&P now, and the bottom line, the second weekly close under the 200-day moving average on a daily chart, 40-week on a weekly chart with a lower low. That's not good. So portfolio sold our RSP, got a little bit of alpha in this versus the S&P 500, a broad S&P 500. This is equal weighted S&P 500, but still did take a small loss on it. We bought that when we popped back above the 200-day earlier this week, but took our small loss on it. We're happy to take small losses. They prevent big losses. Ugly. When you see these sectors up, you know it's generally not a good day in the market. Relative strength on staples, utilities, banks and bonds, oils, tech, consumer discretionary, semiconductors, software, all very weak. So let's get to the key levels here. Starting higher, going lower. We broke out 47.40 to 48.08. This was the prior breakout range. Around here, when we broke above, we were there for about a week and a half before we gave that up. So that was our topping in late December, early January. Prior all-time high was 4,500 to 47.40, which we broke back below that on 118. Declining 50-day moving average broke below that on 113 and haven't been above it since then. Declining 21-day moving average, that's the green line. Broke through the 50, that's a bad sign. And now all we've had is single, and every attempted rally has just been really single closes above it before giving it back up and testing lower levels in the S&P 500. So we're below the 50-day, we're below the 21-day, broke below that on 210. Haven't gotten back above it since then. Follow through range 131 to 211. So that's this area in here, this range above the 200-day moving average. Really, we're in a broad trading range between roughly 4,600 and 4,300 if you exclude this shakeout day here. So continue to see the top of the range sold. Now we're getting down to the lower end of the range, and we're below the 200-day moving average. Very strong support here at 4,300. This really needs to hold. You can see other support here around 4,300 over here from September. These charts have a memory, so that's what the reason for this big shakeout was. On Monday, the 25th of January, you got below this prior low over here, shook everybody out, and then darted back up. Everybody thought that was it. That was the correction. It was lower. We went just matter of fact, we just went too far too fast, consolidated a little bit, popped back above the 200-day moving average, tested it and held it. That's positive, but never could get back above this declining red line, the 50-day moving average. And now we've sold off twice since then, with one anemic bounce in the middle of this week, closing lower. And now this closes 2.4% below the 200-day moving average. Each of the prior two closes below the 200-day were less than or right at 1%. So this first time, this is the most we closed under the 200-day moving average in a long, long time to close the week anyway. So our prior close, 43.80 today, 43.49 is where we are. Next area of support, we're looking at this 4,300 area from these 4 days that tested it and couldn't go below it, from 125 through 128 before we made the latest attempt to rally. So that's the key area that you need to look at for next week. That's what needs to hold, is 4,300. And then the shakeout all the way down to 42.22. If we test that, will that hold? That's what we're taking a look at for next week. Let's go to the Nasdaq 100. Very similar pattern to the S&P 500. You can see the big move down, came up even weaker though, just popped above the 200-day there and then broke below. We did get all the way down to this range from these 4 days from the prior shakeout, and that's where we bounced today. So today's low and the prior lows from late January are what we're looking at for next week, around the 339-ish area, all the way down to 334. That's the last area of support that we want here. Keep in mind, we're below this 350 area here. That was the prior low in September, October, whereas with the S&P, we're still fighting that battle. You can see from a relative strength standpoint how we've been trending lower ever since that top was put in at the end of November. And when you look at it on a chart, that explains why we're have lower lows than that prior consolidation area. Let's go to the Dow Jones Industrial Average, which has been showing relative strength, as it typically does in a sell-off, as this is a more defensive index. Still 1,000 points below its 200-day moving average, and did find some support at 34,000, which it also had support in November and back to these September lows. So a lot more support on the way down for the Dow. Again, very typical that it's showing relative strength. Mid caps, let's take a look at the MDY. This has continued to show relative strength over the last 2 weeks, but still a sloppy looking pattern. We're trapped below the 21 and also the 200 and the 50-day moving average. And the small caps, similar situation, still showing some relative strength over the last 2 weeks. Flagged a little bit with oil giving some back over the last 2 days. That's the reason for that. But again, we're below the 200-day, below the 50-day, below the 21-day. We know when the market's not healthy. This is an unhealthy market. That's why we're limiting our exposure to the indexes for our clients. So let's take a look now at two stock lists. The first one is going to be this gap list that I've been assembling throughout Q1 earnings, and it's sorted by 3-month relative strength. So the stronger stocks you're going to see, for the most part, have held up better from their gaps. We're always looking for gaps up, inflection points on earnings or something new with a company, but very typically it's earnings. And then how does the stock react the day after earnings? Ideally, we want to see a day 2 higher high. We saw that with BTU, and then a 3-day higher high. That's usually the most that you get, is 3, and then you consolidate, and then you want to see where it goes from there. And right now it's holding the ADMA, so this is certainly one of the stronger ones. Arch Coal is a group mate of this and is in the 21 over 21, but these are the type of stocks that are acting well, energy type names. This one, of course, being a coal stock. So next up, I'm going to go through these very quickly. There's 28 of them. SBLK, shipping stocks, also strong. And not all these were gaps. Some were just showed a lot of strength right after their earnings. They didn't necessarily gap up, but we're looking for, again, an inflection point. So it's a big move up on earnings, whether it was a gap or just a big move up on the earnings announcement. And then we want to watch how acted afterwards. So just 2 days into this one on Starbulk, but that's a leading group. Going to see a lot of these with gold. Gold has been, and gold miners have really been the strongest group this week. We're looking for a few flags to be put in these before we can rejoin that group. Zillow, this one is well beaten down, but it is still holding the lows of its gap up. We did get some good housing data today, but ITB, XHB, and all the construction companies, the home builders, have been in the gutter. Royal Gold, another one, big move up on earnings and holding the move. Mattel, nice move up on earnings. In fact, this joined the 21 over 21 you'll see later on today. Move up, a defensive group or not a tech-related or high PE. That's what you're going to, for the most part, be seeing. Those are the ones that are holding up pretty well. OMC, commercial services advertising, not good numbers, but sure was a good move up on earnings, but giving a lot of it back. But then what you want to see on these pullbacks is that the ADMA and then the 21 EMA holds it, and see if it can start building the right side of a base. Airbnb, former high flyer, heck of a correction. Move up and a day 2 higher high on earnings, now a 2-day pullback on lighter volume. This one has the potential to be a growth leader with the numbers that it's put up, should the market right itself. Upstart, big move up on earnings, another one that's been absolutely decimated, flagging after 2 days after its big move up. Docs, another one that was decimated but has numbers to be a potential leader, big move up on earnings, 444%. Volume 24% gain, flagging since then, holding the ADMA. Not saying to buy these, obviously, but these are the types of big, fundamentally strong stocks that we look for to be potential leaders in the next leg up in a bull market. Bill, going sideways after its gap up. Datadog, no progress after its gap up, pulling back. And this is really what the template for what you saw with anything that showed strength. It didn't clear because of prior corrections and weakness in the market. It didn't clear the left side of the base, and it was sold into. This is the typical that you're looking for, and what comes back is, and what you're finding in a lot of cases, it's then finding support at the 21 or 50-day moving average, and it should stop going down right there. But we're going to need the market to cooperate if these things are going to fill out the right side of a base. Tyson Foods, again, very clearly not a tech stock, big gap up, but cleared its base but couldn't hold anything. Visa, big move up on earnings, made a couple of days of a higher high, but now pulling back. MasterCard did the same thing, strong move up on earnings, top of the base, then pulling back. STX, Seagate, very volatile move, pulled back hard, now trending higher. This is really out of the ordinary. You don't see a big long 15% candle, but it did have a sharp move down. Then it bounced, put up decent numbers, harsh pullback, held at 100, and now working its way higher. Snapchat, decimated on its last earnings report. Big move up, 943% volume, up 59%. You're up 59% on earnings, and you're still 50% off your high. That's what's happened to a lot of these stocks, but it's not giving up, going sideways now. Does have the fundamental numbers. Let's see if it can right itself. And these stocks have to come back into favor. They're very clearly not. Hasbro, big gap up, but a big negative reversal also just 2 days into its report. UPS, this one was not good. Cleared all the congestion, not a tech name by any stretch of the imagination, obviously. Low PE at 17, but no follow-up buyers to this. This is a picture of what you do not want to happen to a gap up leader. One bounce at the 8, then it broke the 8, broke the 21, broke the 50, and now headed to the 200-day. I had eyes on buying this one, but it never gave me any strength to want to do it. Big disappointment there. Apple, initial strength on its earnings report, put in the handle of a cup, but now below the 50 and the 21-day moving average. MATX, transportation shipping, day 1 of its move up. Let's see where that goes. It's a strong group, very clearly not tech and low PE. ON Semi, strength, gave it up. What you typically see with PE not bad at 20, but the group technology itself certainly not leading anymore. Qualcomm, same situation. This one actually made a day 2 higher high on its gap, but look how it's given everything up since then. That's just institutional selling. Google, beautiful gap up, big volume to 3,000. Crushed earnings, and all it's done is sell off from 3,000 all the way down to 2,600, showing no real, these moving averages just going through them like butter. Very disappointing. Generac, trying to big correction, trying to reassert itself. Let's see what happens here. This really became kind of a growth stock. It does have a 31 PE, flagging 2 days, and it was stopped at this downtrending 50-day moving average. Lithium, LTHM Livent Corp, moved down before earnings, gap up after earnings, but closed at the bottom of its range. 130 PE, not a surprise. 61 PE for Enphase, big correction, gap up, couldn't hold the 200 or the 50, trickling lower since then. AMD, 40 PE, big growth. The growth numbers match the PE, gap up, tried to rally, but into the declining 50-day, gave up the 21, trying to hold on to the 200-day now. And that's 28 gaps. Let's go now to the 21 over 21 list. First, we'll talk about the 2 stocks that got kicked out last week. Here you can see the full list. And we want to, actually, that's not the full list. This is the full list. 21 stocks sorted by descending order of when they've been added, and we always start off the story with what got punted out from last week. So 2 got punted out. Surprisingly, one of them is an oil company, Apache. This is in the international E&P group, so maybe tied, excuse me, maybe tied to the Russia-Ukraine fiasco. I don't really know, but rare for an oil stock to be breaking below its 21, but this one did, punting it out. And the other one that left, Deere, pre-market looked like it was going to gap up. Absolutely not. Completely sold off. In fact, it did gap up. We'll look at a 5-minute chart here. The gap up, sold immediately, closed at the bottom of its range for the day. From what I heard, it was a decent report, although decelerating EPS. Low PE at 21 versus the growth rate over the next 2 years. Wouldn't be surprised if this one didn't go much further and some money flowed into this, but it was flowing out today. So the 2 added to the list, Mattel, I already mentioned that, gap up on earnings. And the second one is Dollar Tree. Not your typical growth names. Gap up back here, big move up on earnings, consolidating it as the market was weak. Another big move up today with volume after this 5-6 day pullback into the 50 and the 21. The group itself is kind of weak though, but let's see where this one goes. Capri, holding up. Another one, this was a gap up. I'm going to make sure I have this in my gap up group. Gapped up, couldn't clear the top of the base, going sideways, tried to break out, couldn't clear it, continued sideways move, holding the ADMA still above the 21. It's a typical action of what you see after something gaps up. But we certainly want to keep these on a list because they're showing that they have the stuff fundamentally, and they're showing relative strength. It's just that they're not making price progress because of the market. Robert Half, commercial services, staffing, nice move up since earnings, consolidating here, gets to the top of the base, can't really go any further. Very typical of what we're seeing, but increased their dividend, nice numbers, nice relative strength. Datadog, still has the numbers, gap up with a 345 PE, sold off, sitting there at the 50 and the 21. Newmont Mining, we just took our profits on this. all of the gold stocks getting a little ahead of themselves. Doesn't mean they're going to go higher, but odds favor a little bit of digestion here, and that's what we're looking for out of the group. Nucor took our profits on this also after it got to the top of the range. Relative strength, new high. Wouldn't be surprised if this slowly rides the 8 and the 21 higher, but doesn't make a lot more price progress. Then again, it's not a tech stock, so it could break out and go higher. Booking, Expedia, Airbnb, they're all in the same group. They're all acting pretty well. This one consolidating near the high of the list. Seagate Technology hasn't done much since its gap up, barely holding on to the 21, but note the relative strength. Chart doesn't look that good, but the relative strength is that high. Cheniere LNG trending sideways along the 21. Arch, this is the other coal stock I talked about, big move up on earnings. 3-day lower volume flag into the 8 EMA. Schlumberger, big move up here 3 days ago. This was on basically all oil stocks had a big move up on Wednesday on Russia-Ukraine tensions, but they've given most of it back over the last 2 days, and that's this is typical of what you'll see in oil charts. Marathon Petroleum, very strong. Frozen rope there for about 2 weeks after its earnings move, now consolidating back into the 21. ADM, food and grain related, but they support commodities which are hot and fertilizers going trending sideways to up above its 21. Lockheed Martin undercut the 21 early this week, back above it. RTX and NOC look decent also. GLW, Corning, gap up and actually making some progress. Relative strength, not bad, near its highs. Again, everything's being held back by the market. AbbVie, 2-day consolidation after a very nice move up from 128 to almost 145, 146. Berkshire pulling back, lower volume after 3 days of selling right at the 21. Zim, transportation shipping, A+ rated group, basically going sideways for 5 to 6 days now, right into the 21. Got my eye on this one. CF, we on this big strong shakeout before earnings, we had a decent profit go into like a 2% loss. We exited out of it the day before earnings. It's since rebounded on earnings, but pulled back 4% today right into the 21. And finally, Devon. Took our profits on Devon before earnings. A little bit of a gap up, 2-day flag after that, and that's your 21 over 21 leaders list, and that is going to wrap this week's video. As always, love to hear from you. I'm on Twitter, at dvandenbord, email don@revereasset.com, phone 855-REAL-WEALTH. Next week, S&P 500, need to make sure that we hold this 4,300 level on any pullbacks. Would not be surprised to see a gentle move up into the 200-day moving average, which is flat. That's where the rubber will meet the road. If we need to blast above it, we've also got this 21-day moving average coming down, going to pierce the 200 next week if we continue to lag. If you've been watching our videos, we preach that risk picks up, especially under the 200-day moving average. We're 99% in cash. Could go lower, but a lot of volatility bouncing around, failed rallies. This is bear market action. So wrapping up the week ending February 18th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.